When you are standing at a major financial crossroads and trying to decide how to fund your next big project or consolidate your existing debts, the sheer volume of options can feel completely overwhelming, especially when you have to choose between leveraging the hard-earned equity in your home or relying solely on your personal credit profile to secure a loan. Today, we are going to perform a deep dive into the three most common financial instruments, which are the home equity line of credit or HELOC, and the standard home equity loan, and finally, the traditional personal loan. To make this comparison as realistic as possible, we are going to calculate the true total cost over a rigorous 5-year period by examining three distinct credit score cases, which are the excellent credit tier and the good or average tier and the fair credit tier, because your creditworthiness is the single most important factor that determines your interest rate and ultimately the thousands of dollars you will pay in interest expenses. Let us start by looking at the HELOC, which functions very much like a giant credit card secured by your home, where you only pay interest on the money you actually spend, but you must be aware that these usually come with variable interest rates that can fluctuate wildly based on market conditions over a 60-month window. For a borrower with an excellent credit score of 708 or higher, a HELOC might offer the lowest initial rate available, but the risk of rising rates means your monthly payment could climb unexpectedly during the repayment phase. In contrast, the home equity loan provides you with a fixed lump sum of cash at a locked-in interest rate, which offers incredible peace of mind for those who value stability and predictable monthly budgeting, because you will know exactly when your debt will be fully retired down to the very last cent. Now, when we pivot to personal loans, we are looking at an entirely different beast, because these are typically unsecured, meaning you do not have to put your house on the line as collateral, which significantly reduces your personal risk. But in exchange for that safety, the banks and lenders will charge a much higher premium in the form of elevated interest rates. For the first case of excellent credit, the gap between a home equity product and a personal loan might be relatively small. But as we move into the second case of a good credit score, around 700, the personal loan rates begin to spike sharply, while the home equity options remain somewhat anchored by the value of your property. The third case, involving a fair credit score of around 640, is where we see the most dramatic divergence in total cost over 5 years, because a personal loan lender might charge double or even triple the interest rate of a home equity loan, which results in a massive difference in the total interest paid over the life of the loan. Furthermore, we must account for the closing costs and appraisal fees associated with home equity products, which can range from 2 to 5% of the loan amount, whereas personal loans often have much lower or even zero upfront fees despite their higher rates. When you aggregate all these factors, including the initial fees and the monthly interest and the potential for rate adjustments, you begin to see a clear picture of the true total cost. And for someone with top-tier credit, the HELOC often wins on paper if rates stay low, but for the average consumer, the home equity loan provides the best balance of cost and security, while the personal loan serves as the fastest and most flexible option if you are willing to pay a premium for speed and the protection of your home asset. By the end of this 5-year analysis, you will see that choosing the wrong product for your specific credit profile could cost you an additional $10,000 to $20,000 in unnecessary interest payments, which is why understanding these nuances is absolutely critical for your long-term financial health and wealth-building strategy. Starting with the HELOC, it is vital to understand that this is a revolving door of credit, which offers a draw period and a repayment period, And while the flexibility of only borrowing what you need is a massive advantage, the variable nature of the annual percentage rate means you are essentially gambling on the future of the global economy. For our first case, with excellent credit, the bank might offer you a rate just slightly above the prime rate, which looks incredibly attractive on day one. But if inflation rises and central banks hike rates, your 5-year total cost could balloon far beyond your original projections. When we move to the second case of good credit, the margin added to that prime rate increases, and suddenly the gap between a HELOC and a fixed-rate loan begins to close, making the stability of a fixed payment look much more enticing. For the third case of fair credit, getting approved for a HELOC can be a struggle, and even if you are successful, the interest rate floor might be so high that you lose the primary benefit of using your home as collateral. Now let us pivot to the home equity loan, which is often called a second mortgage, and for good reason, because it provides a lump sum of cash with a fixed interest rate and a fixed monthly payment that never changes regardless of what happens in the news or the stock market. In our excellent credit scenario, the interest rate is beautifully low, and when you calculate the total interest paid over 5 years, it often represents the cheapest way to borrow a large sum of money, even when you factor in the thousands of dollars in closing costs and title insurance and appraisal fees that banks require upfront. In the good credit case, the home equity loan remains a very strong contender because it protects the borrower from the volatility of the market and provides a clear roadmap to debt freedom. For the fair credit case, the home equity loan is often a lifeline because the physical security of the home allows the lender to offer a rate that is significantly lower than any unsecured product could ever dream of offering. Finally, we must analyze the personal loan, which has exploded in popularity due to the rise of fintech lenders and the incredible speed of funding, which can often happen in as little as 24 hours without a single piece of paper being signed in person. Because a personal loan is unsecured, there is no lien placed on your property and no lengthy appraisal process, which means you save money on closing costs, but you pay for that convenience for much higher interest rates. For the excellent credit borrower, a personal loan might actually be cheaper over 5 years if the loan amount is small, because the lack of closing costs offsets the higher interest rate. However, as we look at the good and fair credit cases, the personal loan interest rates start to climb into the double digits, reaching 15 or even 25%, which creates a staggering total cost that can be twice as expensive as a home equity loan over the same 5-year duration. When you sit down to look at the final numbers, you have to weigh the total interest paid against the upfront fees and the flexibility of the terms and the risk to your primary residence, because at the end of the day, the true cost is not just the number on the page, but also the impact on your monthly cash flow and your long-term ability to build equity. By